That's Georg Grodzki, Head of Credit Research for Legal and General Investment Management. Mr. Grodzki, very good morning to you. How tough is it going to be, this recapitalisation plan, getting that core Tier 1 capital to 9% for the Italian banks, the Portuguese banks, the Spanish banks?
It's going to be quite tough. To find the right number, as we've just learned. It's a moving target. How much needs to be set aside, how much needs to be raised in order to be cushioned against future falls in government bonds is something which is not scientifically to be established. So number one, what kind of tolerance will the market have in the future for less and better capitalized banks? And then secondly, where do you get it from? The
well, I was going to ask you, that was my second question. Where is this money actually going to come from? Because actually, in the grand scheme of things, it's not massive amounts of money. However, it's a lot of money for these countries. Absolutely,
because it's highly concentrated in certain geographies, and that's Southern Europe more than others. Some banks, of course, are arguing for a longer period of time for this capital to be raised, which would allow them, to the extent they have positive earnings, to generate that capital from internal sources, that is earnings. And certainly you can see that some German or French banks are preferring to go down this route because they would avoid dilution for their shareholders. For some banks that certainly won't be enough because A, they don't have any earnings, and B, the shortfall is such that it would take them years to earn their way to the required capital levels. So the likelihood is that some kind of support will have to be provided, at least in the interim, and then the question is, can the governments in those countries actually afford to support their banks? Because that wasn't an issue 2 years ago, but no, all the market's focus is on the balance sheet of these governments as well. So therefore, the markets will very quickly aggregate the total average and realize that these governments themselves are not strong enough to provide support to their banks. And then will there be a call facility, will there be a standby facility, so to say, from the EFSF, which could then help to recapitalize those banks? Of course, that's a contentious issue.
I mean, how big would the EFSF, though, need to be to give assurances to those in the market that it can actually do all of those things?
Well, any number you can think of.
Think of a number.
And double it, because in extreme scenarios, you not only have to look after the Italian stock of debt, which of course will need to be refinanced over the next few years. You have to think of the stock of debt of other countries as well. And of course the big elephant in the room is France, which so far didn't have any issues funding itself, but who knows.
Can I also just press you, a little bit more on how the EFSF could actually reach this number that we could double? So what we're hearing now is that they could set up some type of special purpose investment vehicle. Would that actually do it? I mean, what are the kinds of options that are out there?
It will really depend on whether the market will accept bonds issued out of that vehicle with the type of credit enhancement which they're now thinking of. And it's not a given that the market will happily buy into this structure at any price. And we have seen already in the past few weeks some meaningful widening on the spreads of the existing EFSF bonds. And therefore we have to watch that space relatively carefully. If the cost of funds for the future EFSF was to be higher than the rate at which they are passing on that money to the recipient governments, then of course the whole model falls apart, because it would suffer a negative carry. Who would pay for the, if you want, the negative interest margin? And also, wouldn't it be unfair if governments receive aid and not only get the benefit of the guarantee from other governments, but also get an ongoing subsidy in the way of this negative carry?
Now, you can see why so many banks are pushing against the 60% haircut, because that's a term that's been mooted now, actually, certainly in Germany. Is that needed, Georg? Is that what they're going to be forced to take?
Very good question. The banks can actually stomach the 60% haircut on Greece. Obviously, it's unpleasant, and some banks in Southern Europe will have to raise capital, but...
Will some of those banks go under? Will they be allowed to go under?
Well, Greek banks certainly would have a major issue and will probably need to be nationalized. And that's about it. I don't see any immediate implications in terms of serious capital shortfalls for Italian banks. For some French banks, they may have to consider some capital management exercise, but it's doable. The stock of Greece debt is significant, but the proportion held by banks is manageable. When we talk about recapitalizing banks, it's not so much to protect them against the consequences of a 6% haircut on Greece. It's about the mark-to-market valuations of their holdings of other governments.
Yeah, I was going to say, just very quickly, why the pushback from the banks? It's that, isn't it? It's all the other government bonds that they're holding.
Exactly. And of course, as far as Greece is concerned, the Greek debt situation is thoroughly unsustainable. Anything less than 50 or 60% just wouldn't be enough. We would have to have another round of haircuts next year, which would be even more damaging for credibility.
Okay. Georg Grodzki, Head of Credit Research at Legal & General Investment Management. Thank you very much, Linda, as well. I'm grateful to you.